tax man is often one of the scariest people in the lives of entrepreneurs who are trying to execute a challenging balancing act. That's when it comes to managing cash flows. With tax season around the corner, we look at what entrepreneurs should be thinking about and how to stay on the right side of the law. To discuss this further, we've got Pete Nell, project manager for tax at SAICA, and Gareth Osh from Mission Control still with us at the desk, and of course Simona. So Pete, thanks for joining us, and let's just talk about what has government done to make to encourage small business growth and to encourage more entrepreneurs in South Africa when it comes to tax incentives?
Yeah, there are not many tax incentives for small businesses. So we have commented on that in the past, that you know, we have a small business corporation definition in the Income Tax Act where they give certain incentives to small businesses, and the micro business then they define as below R1 million turnover. They have a differential. They don't have to submit returns. They just declare. They don't have to keep record of their accounts and just pay tax on the actual turnover. We certainly believe that there should be a bit more incentives, and we're hoping that in this budget coming up, and we'll make some submissions in that regard, that there are more business, particularly I think in the compliance side. You know, your small businesses I think find that very hard to comply with SARS. If you have employees, you must submit monthly employee returns. If you're VAT registered, which you normally will be, you've got 2 monthly VAT returns.
From your perspective, Gareth, of course, we're talking about tax season. We're also talking about the budget coming up in February right now. Is government being too onerous on businesses? Because the other side of the coin is that government needs to kind of have checkpoints. I mean, I was talking earlier this week about Italy, where small businesses, their coffee shop owners, have to give every single customer an invoice, and it's illegal if you don't, because of the implications on not collecting that tax there.
Well, we still like Italian coffee though, so government's doing something right. But as Peter was saying, the key thing from a small medium business perspective in South Africa is there's a very onerous compliance load. So there's a number of requirements to submit returns monthly, bi-monthly. They are to multitude of government departments. They carry a multitude and a complexity of fees and levities and penalties if you don't get it right. And that's really the core thing I'd love to see, is for the government to help unlock the entrepreneurship that's kind of latent in our economy by taking away some of these barriers, and rather lumping them together under a single, more easily manageable and more easily to comply with system. So that would be a fantastic change in the budget, but I don't expect it.
I was under the impression that the turnover tax was actually meant to alleviate some of those administrative burdens, where, you know, VAT wasn't required to be, you know, mentioned separately and things like that. You say that it hasn't actually taken off. You know, people have had to say, if they are keen, they're locked in for 3 years. If they're not allowed to do it for 3 years. So why is it not popular?
Yeah, I think the last stats I saw that there's only about 6,000 or 7,000 firms that had applied, or businesses for this turnover taxes, the micro businessing. It's limiting in that it doesn't extend so much to services. So if you render services, you're practically locked out of that as a professional person.
So you have to be making a physical product.
You have to be making physical products. And then, you know, if you think on most startup businesses, and this is, I mean, the one benefit of it is that you've got a single registration, single return that you put in. Most startup businesses suffer losses in the first year. Now, if on the turnover tax, if you make a loss, you still have to pay the tax because you've got turnover. So that's one of the reasons. It's also not popular, and a lot of people advise them. You know, if you come to me for consulting advice, I would say, look, I don't think you should go there.
So just to add to that, I mean, it's most of your micro enterprises are the services businesses.
No.
So the turnover tax by nature excludes most of the people who probably find it attractive.
Who's potentially trying to target.
Yeah.
Exactly.
So it doesn't appear to be working, and of course we need to see whether government is going to address those areas that of course are not working right now. When it comes to tax season, there's also been changes to deductions, and what is applicable as a deduction when it comes to entertainment, when it comes to travel, when it comes to even bad debts. What's changed? What do small businesses need to be particularly aware of?
If you're an individual, and entertainment, of course, the law has always been like that. It's just been more strictly applied, where you can't claim if there's a personal component to it. And with entertainment, you often have that, you know, that conflict. That you entertain to grow the business, but you also have this personal thing. So that has always been there. It's just that SARS is policing it a bit more strenuous now. With the debt and the big changes there is really where you cancel debt. So if a small business has And this has become effective only now when the Act was signed. And in fact, it hasn't been signed by, it's in the bill yet. And I believe that the bill was referred back. So it's not been signed by the President. But they've changed significantly the way in which they deal with, and I must say, to a better, it's a better regime that we have.
If you incur bad debts as a small business.
As a small business, you write it off. There are two parties to it. The one party benefits from not having to pay you, and they're looking at both of that and saying, look, if you don't have to pay, then you have a recoupment. If it was a tax deductible thing, we will tax you on this recoupment. If it was a capital thing, we'll treat it as a capital gain. For the person writing off the debt, you must prove that it's not collectible. There's a timing difference in which one account for it, but principally you will get the benefit of having, and that's the difference with the micro turnover. There, where you work on turnover, if you actually just work on cash, which is for a small business useful. But if you're not micro, you have to account for even your sold on credit. So you've accounted for it, paid the tax. If it now turns bad, you get the tax deduction, but you were out of pocket with the tax of having paid the tax on the thing already.
Yeah.
But at the same time, there's a nice incentive there to persuade people that owe you money that they're going to have an onus of compliance if they can't pay you.
Yeah.
So I quite like it because it forces your debtors to pay up. It just puts an extra structure in there.
Obviously, I mean, we're really round the corner from when we need to submit our provisional forms. Are there any loopholes? Is there anything that you can tell readers at the moment?
Let's not use the word loophole. I don't think that's allowed anymore, but are there any areas that people could benefit from, perhaps?
Even it's late in the day.
Yeah, when the big thing with one must understand with your provisional taxes, and I want to put it in the context of the new tax administration bill, and you've referred to the penalties. The big thing is that you have to estimate your actual income for the year to make an upfront payment of tax. That's what the provisional tax system is, and we found through our member base that people often get this wrong. Even if you put in a lot of effort, you practically always get it wrong. Not always, but you often get it wrong. In the past, the penalties were raised on the estimate if you had underpaid the taxes, and it's a standard 20% fixed rate penalty. Now they've changed that system to exclude lump sums, so those lump sum from retirement funds, because it's a separate tax. It's excluded. Severance benefits is excluded, and also they've said that if you get it wrong, and these were in direct submissions that we've made, and said that if you get it wrong, we understand that it's an estimate, so we will only penalise you if you haven't paid enough tax based on the estimate. So they have certain minimums. If it's below R1 million, you must estimate at within a 90% accuracy. If it's more than R1 million, it's 80% accuracy. If you don't get that right, there's a 20% penalty. But they would say, if you then also, in addition to making a mistake on the estimation, have paid too little tax, we will penalise.